Good morning. I'm Jim Barlow, OakTree Premium Finance, and we're here for another webinar. The greatest financial fears, concerns, and problems. I really enjoyed putting this webinar together. Oh, there we go. I got those things from off the bottom. I was making a few changes even this morning as I was thinking things through. Sometimes in the night you think of things, oh, I'd like to do this a little different. Well, I think this should be helpful. I think it should be a helpful webinar for a lot of people. Let's get started. Greatest financial fears, concerns, problems. I could have named this the needs and wants we have, but for individuals who have moved past concerns related to day-to-day expenses, debt management, saving for emergencies, educational costs, and housing, their financial focus often shifts to more advanced financial planning and wealth management. These concerns reflect a focus on sustaining and growing wealth, optimizing tax liabilities, planning for the future, ensuring one's financial legacy is preserved and managed effectively. You know, I'm sure you listening today that you remember those days. You remember day-to-day expense issues, debt management, saving for emergencies, putting money aside for education of your kids, housing costs. I remember all those days. And when you see your grandkids and when I see my grandkids in that era, in that stage, I smile a little bit because it's good. We learn, we grow. I'm assuming that if you're here watching with the webinar today, you're beyond that. So let's get started with what I think for most of us are going to be issues. The greatest financial fears again, retirement savings, right? I think this is the number one. Do I have enough money for retirement? Am I saving enough for retirement? And that's the biggest. Then the second one is medical and long-term care. Do I have adequate coverage and funds for medical expenses? Do I have adequate coverage and funds for long-term care expenses? What can I do about this? Next is estate planning, ownership methods. Do I have the right trusts or other legal structures in place? Are my beneficiary designations up to date? Oh, my lands, I'm continually startled when I see movie stars, wealthy people, all kinds of different industries and lifestyles with no estate plan. Oh my. I've had my estate in trust forms for many, many years. My mom had a trust. My sister and I, as she passed away, we ran the trust. It went really smooth. I've done it for a brother-in-law that passed away. Ownership issues are important. Next, protecting the estate. Have I taken steps to protect my estate from creditors, lawsuits, other issues, taxes? Another big important one, gifting. Am I leaving my money in a proper way, a meaningful legacy through my estate? How can I effectively make charitable gifts from my estate? What's the right things to do? Couldn't put them all on one PowerPoint, so the next three, tax management. How will taxes affect my retirement? How can I manage medical and long-term care expenses with tax implications? And all the other financial fears and concerns, taxes. You realize that in retirement, your number one expenses is taxes. And for the business owner, do I have a funded succession plan in place for my business that I feel confident about? And if you are that business owner, am I effectively offering benefits that can help in retaining, recruiting employees? I think these are the most important. I added others. I took some off, made this list. This is kind of the list without the questions that we've gone over. I think it covers most of the areas of life. And just as a preview, as Kaizen, my #1 product, answers 7 out of 8 of them. Can't do anything with ownership issues, but an important one. So, the greatest financial fears. I'm going to cover the first two. Not enough money for retirement, not saving enough for retirement, not enough money for medical needs. I guess you could almost call this webinar not enough. Not enough for whatever. So, oh my, the world's interesting. The largest number of people retiring in U.S. history, not enough workers to fill the jobs, high healthcare costs, Medicare, Medicaid, Social Security running out of money, high inflation, national debt, 34 trillion. I might be even low now. That probably has gone up. There's issues, and I'm trying to protect my wealth from these issues, and I want to help others protect their wealth. So we're going to go over the retirement gap. We're going to go over the medical gap, the payment gap, and we're going to show you some solutions. First, the retirement income gap. Need more money. Americans are some of the worst savers in the developed world. Oh, that's not nice. 90% of all households earning over $200,000 are chronically undersaving for retirement to preserve their current quality of life. Top 10% of income earners save on average 9 to 12% when they need to save more. They don't have enough. Fidelity rule of thumb, aim to save at least 1 time your salary by 30, 3 times by 40, 6 times by 50, 8 by 60, 10 by 67, 6 times by age 50. Are you saving enough? I built a retirement income gap calculator, and I'm going to shift screens, get my mouse to where I want it to go, and change to this other screen. Okay, now you're seeing my website. And on my website, if you scroll down in the quick links, the first one that you come to is a retirement income gap calculator. I'm going to click on it. And here we have the calculator. And I made it simple so you can sit down. You don't have to go grab all kinds of tax reports and papers and net worth statements. Let me just give an example. Let's say you're age 45. And I have it automatically set at 65 for a retirement age. But if you want to change that, there's an arrow here. We can go up or down or wherever. I'll leave it at 65. I have an inflation rate that I've set at 2. If you think that's too low, you can go higher. It could be 3 in the future. I'll leave it at 3. Then you put your current annual income, whatever it is. Let's say it's 200,000. And on the right side, you're going to start seeing that the calculator is starting to work now, and showing you what your income gap and the assets you need. And then we're going to say estimate annual additional. This is if you think, oh, I'm in a low paying job, I'm going to get better. This is where you add something more to that income, or maybe less. Then you put in your total annual retirement savings. Let's say you have 500,000. And then you put down the anticipated return on your investments. I have it locked in at 7, but you can change that to 8 if you think you're going to average 8 or more or less or whatever. And then you also put an age where, and what this is designed is that this is, the money is going to run out at this age. In other words, we're going to use every penny. I have it automatically set for 90, but if you feel uncomfortable, we can raise that to anything you want. I'll go ahead and raise it all the way to 100. And it actually did the calculations, but there is the calculation button to click, but it's already done. So you need to have you have a gap right now from what you need and what you say, oh, 239,000. So I hope use this calculator. It's free. It's on my website. Now I'm going to go back to my main screen and keep going. Here is a statistic that everyone really needs to be aware of. The biggest impact on how much you will have in retirement is the amount invested, not the rate of return. 74% is based on the amount you've invested, the amount of money you have set aside. 26% is the rate of return you're getting. Oh, I was in the investment advisor for 35 years, and the rate of return is the category that I worked in. This is what I try to get a higher number for people. I could tell you a lot of interesting stories, but usually if people had problems with retirement, they didn't have enough money set aside. It wasn't an issue of the rate of return. So there has to be more money set aside. So we're going to cover the medical expense gap first. I guess okay, sorry. 66.5% of bankruptcies filed due to healthcare costs. Why? Time off work and or high cost of long-term care. I talked to a lady in her 50s. She came to me to see how I could help her with getting ready for retirement. She told me her story that in her 30s, her husband got cancer. He had to quit work. They went on COBRA, not to give a health insurance class, but COBRA is taking your work medical coverage and moving it to an individual plan, which is higher. So they're still on health care. They still had a medical plan, but they had deductibles every year, the deductibles, and he wasn't working. So they had to make do and pay expenses and pay medical. They had to start selling assets, selling their cars, selling whatever they had. They didn't take out bankruptcy, but they basically lost everything, and then the individual died. And here she was in her 50s, wanting to figure out how to retire. Even if you have health insurance and Medicare covers those over 65, there's still costs that you've got to pay. So these are things you need to be aware of. 1 in 2 people will develop some form of cancer during their lifetime. On the little circle on the left, people over 65 who will require long-term care, 2 out of 3. Wow. Average length of majority of long-term care claims, 3.8 years. Next circle, average life expectancy after Alzheimer's disease after age 74 to 7 years. Estimated percentage of people age 65 and older who will need long-term care during their lifetime, 47% of men, 58% of women, 33% will need nursing home care. We need to have a plan for this. And are you saving enough? Afraid to part with some money, saving for a rainy day, have big plans for that money, don't want to lose it, might miss the opportunities? Well, the product is my primary product is Kaizen. Some of you have attended webinars before, some of you own it from me. But we're going to talk about how this can help with some of these fears and concerns. This is my list of the key features of Kaizen. Not going to spend forever on this chart, but let's go over it. Potentially tax-free withdrawals. Now, most of you should know this is the life insurance policy that's structured and designed a little differently, where we're going to build up cash value. The money grows in this policy tax deferred, and when you pass away, your heirs receive insurance money tax free. And as the owner, you can access cash value using a tax free loan. So this is an investment will give you tax free returns. We're never going to pay the money back. We're just going to make sure we always have the policy. It eliminates tax risk, eliminates taxes. 2, no negative returns, 0 floor due to decline in index. Policy floor prevents negative crediting rates. You need to be let's cover this in a bit. But eliminates no negative returns, mean no downside market risk. Upside crediting growth potential. If you're in a S&P 500, you're capped, but you still have 0 downside. The average for the last 10 years about 8.2. There's also participating indexes. One of a popular one in a lot of policies is the Bloomberg U.S. Dynamic Balance 2 ER. I don't know what the ER stands for. The 10-year average is 5.4, but they have a participation rate right now of 218.5% in this index. So you times that by the 5.4 and your 10-year average, if you have that participation rate, there's all that time, 11.88. I like the participating indexes because I like not having the cap, and I like the over 100% participation rate. Good upside crediting growth potential. Reduces market volatility and investment risk. 4, the first 3 is really just index universal life, but 4 is now Kaizen, where we're going to borrow up to 3-to-1 leverage. I call this a seeding. We're going to seed this policy with debt. Doesn't sound cool to seed it with debt, but the debt, the borrowing, is what makes Kaizen hum. And as we get into an illustration, I'll show you. But really important along with this borrowed money is without collateral, without personal guarantees, with no loan documents, no interest payments, no credit checks. As far as you know, there's no borrowing. This leverage is going to give you more money, substantially reduce capital risk, getting more money. 5 annual payments, reduce payment fatigue. A lot of people buy policies and can't keep doing it every year, and so they quit. So we're trying to made it very possible, just do 5 payments. Death benefits and living benefits. I could have put this up higher in the list, but yes, you have the death benefit, and that's good for it because that happens in families. But the living benefits is amazing. You've got benefits for terminal, chronic, critical illness, critical injury. This is like buying life insurance with supplements for disability insurance and supplements for long-term care. You're attacking that disability issue. If you get cancer, you're attacking if you get in an accident. You're attacking if you need long-term care issues, which I showed you earlier, a lot of us will. I think these 6 features and advantages are amazing. But I want to show you the downsides, the drawbacks, the limitations. Qualifications: requires eligibility for life insurance. If you're not eligible to buy life insurance, you can't have it. I wish everyone could, but you can't. And you really have to be eligible at a pretty high level, preferred or standard. So the qualifications. 2, age limitations, not available for individuals over 65. Optimal, in my opinion, is under 50, and minimum age requirements of 18. Age limitations. Some people can't purchase it. I cannot purchase Kaizen anymore. 3, financial criteria of the insurance companies. Insurance companies require varying levels of net worth, ranging from $1 million down to 0, based on household income, ranging from 100,000 to 400,000. So you might not make that net worth income requirement. 4, minimum contributions. Those 5 payments range from 20,000 to 50,000. Based on your age from 18 to 64. Interestingly enough, the average contribution in the country is 70,000 per year. So most people who are buying Kaizen, they're not trying to get the minimum, they're trying to get the maximum benefit because they like it. But there are minimum contributions, and that's a negative. And 5, long-term commitment, ideally suited for those committed to at least 15 years before accessing benefits. If you're a short-term investor, this is not for you. This is for someone who will put it in and keep putting in for the 5 years and then leave it alone. I'm going to address this one more time before we wrap up the webinar, but there's the positives and there's the negatives. I do want to mention, how does an index universal life earn interest? So your payments go in and they take out the cost for insurance first, and then the rest goes into the general fund of the insurance company, which is an investment in big pool of bonds, government, corporate, whatever, safe bonds, not aggressive investments at all. And when I say majority goes into that, maybe 90 to 95%, and a portion goes to buy options, and that's the options is where they buy options to duplicate that SP 500 with a cap. They buy options to duplicate that index with a participation rate. That's because the majority of the money goes into the general fund and grows to your net value. That's why you can't lose money. That's how they earn money. You're not really most of your money is safe, totally safe. Let's do an example. Index Universal Life, a male age 45 in standard health, not preferred, standard, and he's putting in 35,000 a year for the 5 years. So they have 580,000 death benefit, and they have living benefits. I've got 2 underneath that on the left there on the bottom, chronic illness and terminal illness. Every insurance company approaches living benefits a little different. One of our companies has those 2. And on the right, another one of our companies, in addition to those, has critical illness, critical injury, and Alzheimer's. So, but this is the living benefit. This is to cover medical expenses. This is to cover expenses in long-term care, for paying for cancer and whatever, and your income, whatever. So these living benefits is this medical issue that's covered along with the death benefit immediately. Now, in this policy that we're using example, the gold in the jar is to cover those costs for the insurance. And the rest, the money goes in of that $35,000, is going to build up assets to potentially give you tax-free distributions at some age. We put 65, and from so excuse me, so that 35,000 for 5 years is at age 65 is going to give this person 38,000 per year, tax-free, starting at age 65. And from 65 to 90, they'll receive 988,000. This looks like an interesting tax-free investment. This is, and I'm showing you what is not Kaizen. So let's get into the Kaizen, how that works. I mentioned the 5 payments. That's the silver pigs at the top. 5 payments. And while you're making those 5 payments, the bank involved is paying about the same amount into your policy, 5 payments. Then at the end of your 5 years, you're through making payments. But the bank is going to continue making the payments they were paying for the last 5 years, but they're also going to pick up making the payments you were paying for the first 5 years. So you can kind of visually see that's about 3 to 1 debt leverage to equity. And I already mentioned this, there's no financial underwriting, there's no loan documents, no out-of-pocket interest payments, no personal guarantees. There's no additional liability for the loan other than the 5 annual payments. If you quit doing one of the payments, the first person to get money out is the bank. They're going to be paid back first. That's fair anyway. So here we are again. Here's the policy we showed. 580,000 with the living benefits, giving an income of 38,000 to 988 total. And now we're going to add Kaizen. Now we raise the death benefit to 924,000. We've got more death benefit, and we've raised the total we're going to receive from 988,000 to 1.4 million, about 50% more. And we're using conservative rates. We're projected this at a 6.7% interest rate. Average loan rate is 5.6, and the spread of 1.1. Interestingly enough, we've never had a 15-year period of time since the 1930s when the spread for our client or for this strategy has been less than 2%. So that 1 million and 4 million is probably low. And we've stress tested this strategy. We stress tested it for the 1980s of high interest rates. We stress tested it for the 1930s of a bad market. And these numbers are kind of low, but these are the different eras that it did okay, better than investing on your own. Here's another piece of information I want everyone to understand. Your costs in the early years is high. Not a short-term sale, not a short-term investment. But if you keep it, see that way down there on the right, weighted average cost to age 100, 0.46. Wow, now that 0.46 is amazing. The average cost goes way down as you keep it. The average mutual fund has internal fees of about 1%, and most advisors charge about 1%. So usually if you're using an advisor, you're probably paying about 2% per year. And this long term is going to be the 0.46. So long term it becomes very inexpensive. The founders of Kaizen, who designed it, and my partner, they're my partners in business, is NIW. They've been in business 25 years. They've done 6.8 billion of lending, highest persistency rate in the industry. And Kaizen was, they build it for themselves, for their employees. I love it. And that's who my partner is in bringing you Kaizen. Here is a statement. This is a statement of one of the founders of NIW. And you can see at the top, her name is Grace Bernard. This is her actual statement. You can see every year, you can see what return she made. You can see what interest rate she paid. You can see her payments. You can see the bank's payments, and you can see the values where they are today. The Kaizen has been around a little over 10 years. So we don't have anyone getting income yet. We can see that the strategy is going to be ready to roll and working. This is a chart made by myself. I mentioned ideally for less than 50. Remember the 5 years of payments, the 5 years of additional payments by the bank. I want another 5 years for this to grow and be ready. So I need 15 years before you take any money. And if you're age 50, you had 15 years, that's 65. And that's supposedly the age that a lot of us retire. So that's why I put in green, less than 50, and over 65, it's over, you can't buy it. And if in the middle, it depends on your objectives and where things are. If you're over the 50. And there's the gifting. There's a different rule if you're gifting money to a child or whatever. There's some additional rules, but generally speaking, less than 50 is the sweet spot. So the greatest financial fear is not having enough money, not money for medical, and not saving enough. Kaizen addresses those. It's also used by companies as a executive employee benefit. A lot of, well, maybe even yourself, this is a great way to cement a great relationship with your employees. Give them life insurance, give them disability insurance, give them long-term care insurance, and retirement. And another big use of Kaizen is to transfer wealth to your kids. Here you're buying a policy for them and you're making the payments, but they really can't tap it for 15 years. So that kind of protecting the wealth and letting it grow in their name, a big time use here. This is how we use Kaizen. So retirement income, that's the biggest area. Then there's executive employee benefits, transferring wealth, but a lot of people just use it as their life insurance policy because they like the growth that it's doing in infinite banking. It can be used as a fixed income alternative. It can be used for a buy-sell succession plan, working on a couple right now. It can be used just for key person protection in your business. So we have a software that the builders of Kaizen has put together. They call it the Interactive Learning Information Assistant. You have to be have a login and a password to explore this, but it's available to you when you get a login and password. I'm going to move to my website again. So again, this is the home page of my website. There's the beginning. And then we have these quick links down here where I show you the retirement income gap. The third one down is called, I call it the Kaizen Secure Portal. So I'm going to go to that. And I have a login and password, and it goes through it automatically. And for me, I have a portal for servicing clients, and that's what comes up when I pull up my ILIA, this Kaizen portfolio. But I'm going to go to my picture up here in the right upper corner and go to demo. Then I'm going to select a carrier. Our two main companies we use is Allianz and National Life. Each has their own specialty and what they're best for. I'm going to use Allianz. They're the world's largest insurance company. Boom, the world's largest. So here we are going to the demo. And on the demo, on the left side, we've got all kinds of information. And NIW, the founders of Kaizen, says this along here, all the details here, all this information will answer 98% of your questions. And guess who knows the other two? I hope I do. But I know a lot about Kaizen. But here you got all kinds of information. It's even the place where you enroll. And when you decide you want to do it. But you can look about leverage, you can about minimizing risk, and there's talks about all kinds of things. But the thing I want to go and show you today is the estimate my benefits. And on this page, we have a quick results estimator and a custom design estimator. And to start, let's just do a quick one. It's set at 18-year-old male. Let's change that. Let's do a 40-year-old male. Then down here we have a little bar to adjust the payments, and I can go more, I can go less. Okay, I just went to 50. So we're going to do a 50,000 payment per year for 5 years. And we're going to click this calculate again. And here, I think I might have made a mistake. Let's try to do this again. Put annual contribution of see the 0. I don't like that. Oh, okay, it worked out okay. So here we go. On this illustration, we have the 5 payments. We have the 5 bank payments, and then the payments for 10 years. Here's the contribution. I did 50,000 a year, or 250,000. The bank is putting in 702,000. So 952,000 is going in. We're going to use a growth rate in this fine print of 6.71. We've averaged probably 8.5 for the last 10 years. But we don't want to illustrate at 8.5. I think 6.71 is fine. I'll mention some things after we finish on that. But so next, let's go look at the benefits of distribution. So here we go. For this 40-year-old, we're going to buy a policy of $1,634,178. We're really trying to buy the least amount. If you want to specify the amount of death benefit, we can do that in the custom field, but we didn't have that option here. And with the borrowing, even though we're doing a 6.71 return, with the borrowing, this is showing an internal rate of 8.81. And when this 40-year-old turns 65, we can start giving them a check for $127,000 a year, tax-free. And by the time they hit 90, they will have pulled out $3,302,000 from a $250,000 investment at age 40. At this point, most people say, what? How? Too good to be true. Well, it is pretty good. It's amazing. And it's just the way it is. And you still have a death benefit of $1,586,000. When I finish on this page, I'll make some comments. But next, let's go to comparison. Comparison, I do a bar chart here. And this first one on the left is the Kaizen. The gold is the death benefit. The blue is the total distribution from age 65 to 90. The next to it, this is the same policy, but without the borrowing. Then the next one is you investing at the 6.71, making that same return over all those years, and paying taxes as you went. And then the other one is a 401k or IRA. And here's the exact numbers if I scroll down. So remember, we had an income of $127,000 tax-free in the Kaizen. If we didn't have the borrowing, we'd have $82,000. In a regular investment, getting the same return, you'd have $54,000. And in an IRA, 401k, you'd have $69,000. The borrowing is what makes this thing hum, that makes this thing great. Next, I want to show you a custom. The custom's a little more, is slower, but we do a new custom design, and we're going to have to answer questions. Oh, client first name. I'm going to put A for the first name and the last name of S. And then we're going to put a date, a birth date, 0101, 1990. Age 34. Oh, let's make him a little older. How about 1980? That's a 44-year-old. Okay, let's stay there. Select gender. Select health. Either average or excellent health. I'll do excellent. Does this client use tobacco or marijuana? Those things do affect the cost of insurance. No. Next. Are you just wanting to do this for a maximum death benefit or for a potentially retirement income? Most people are the second box. I could spend a webinar about why you do the top one, but we'll do the second. And now we have a place, instead of a slide bar to decide how much we're putting in, we can put in the exact amount. And for this person, what was he, 44? The minimum is $21,350. So, well, let's go with the, remember that average in the country, 70,000? Let's do the 70. Over here, it says annual or monthly. One of our companies does annual only, but Allianz that we're using can do it actually by a monthly if you want. But we'll just leave it at annual, 70,000. Here, if we're talking to an employer, this would be an area where maybe the employer has agreed to match. It might be a tough one to match 70,000, but I'll match 25% or something. This is if your employer wants to assist you in your plan. I'm going to skip that and go to next. Then we select our own age. We're not just automatically 65. We can start our income at any age we want. And we can have the ending date when the money is all gone. For my illustration purposes, anything we want. I'm going to change this to 100. Yeah, let's leave it at 65. All right. So now we're going to click next. And then we can do SP 500, or we can do that. They call it Busby. I forgot the name of it for earlier, but I'm going to use that one, the more conservative, the Bloomberg US Dynamic. I'm going to use that one. And I'm going to click that. I know what we're doing, that one, and then we're going to view results. Now here on the results, it's crunching numbers. This is a little bit slower. They use the word stress testing. They want to make sure whatever age that this is going to work. They've already stress tested this for over 65 and it failed. That's why they don't sell it for over 65. But maybe if they're standard and they're 64, it would not meet the stress testing. But this is just takes, it says about a minute, but we're going to see the results in a jiffy. I'm trying to think what I should mention while we're waiting. Can't think of anything. I think you'll enjoy seeing this more detailed illustration. We'll just hold on. Here it comes. So here we have the exact same result. We have the 350,000 contribution. The bank's putting in $1 million, so $1,362,000. We can look at the benefits. The death benefits $2 million. At 65, we're going to get $143,000 per year. We're going to be pulling out $5,148,000 total from 65 to 100. We went to 100. So and we're still going to have $1,845,000 death benefits. And the comparison, let's just look at the numbers. 143 for Kaizen, 87 for without the borrowing, 54 regular investment, 69 IRA 401k. Wow. Kind of too good to be true. And way up at the top, see this view illustration? Here, we have crunched the numbers and provided reports. Here's the client report, NIW Kaizen, prepared by Jim Barlow. Remember the name? It was AS. And here we got an illustration that I can print for people, or you can look at this and print it yourself, because you can design it and play with it on this site. You don't need me to do this, but you've got all the explanations of this you want. Way down here, you've got the fine print illustration. So you've got a lot of information, and you even have the carrier illustration, in this case prepared by Allianz, which is really long, a lot of information here. But anyway, this is the Ilias site that you can be invited to. What I need for send you an invitation is I need your name, I need your email, your cell phone number. Those are pretty simple things, and your birthday. That's really all I need. So if you send me an email or reply saying I would like to have an invitation, then I'll send you the invitation and you'll be able to log in and set up your own password. And you can explore this to your heart's content. I call this the Amazon world, where we we pull up Amazon and we look for something we might want, or design it and decide what we want and find it and push the button and buy it. Here we are in this world. But I'm still here, but you can still do it in this new Amazon world. So let's go back to my presentation. Okay, remember that page? That was my page to let me know it's time to move on. Allianz did a study. They said, how predictable are these Kaizen illustration income projections? We just looked at some. They discovered that 7% probability of less return, 93% probability of the same or more, and 80% probability of doubling. In other words, all those numbers we just saw are double. And you thought that was unbelievable or too good to be true. Well, we wouldn't even dare illustrate that. But probably the results, 80% is going to be double. Next, hate to tell you, but you and I are human beings with normal feelings. Dalbar, a company that I've looked at and followed for years, they do analysis on investors and how we do. This is their 2023, they call it the Qualitative Analysis of Investor Behavior Report. And over a 30-year period of time, when the market has averaged 10%, and investors have averaged 3.6, 6.4% gap during reality. So the reality is, if you're investing on your own, if you're a normal person, you might make some mistakes. The average investor do not do very well. They sell when they should be buying and buy when they should be selling. So between the illustration being low, and it could be double 80% of the time, and investors might not get the 6.71 that we're using, this is a very conservative approach to life and your retirement and your medical. So we're about wrapping up things. Hope you've enjoyed being with me today. Remember this chart we had earlier, the downside, the drawbacks, the limitations? Well, I want to talk to you about the last one, the long-term commitment. Ideally suited for those committing to at least 15 years before accessing benefits. If you're not feel really, really comfortable with that 15 years, don't buy Kaizen. The analogy I want to make is a rocket. We could use a lot of different analogies, but this is a fun one. The launch phase of a rocket launch, the energy usage is 95 to 98%. The orbit phase of the energy usage is 2 to 5%. I'm saying the launch phase is 15 years. If you only have 90% in your rocket of the fuel you need, it's crashing to the ground. Not going to make it. If you don't have the 15 years, this will not perform the way I want it to for you, or that you want it to. Primarily because we've tried to boil those costs down as much as we can, but those insurance costs in the early years are substantial. They give you those living benefits, disability, long-term care, and death benefit, which I'm thrilled about. But for that retirement income strategy, you need the 15 years. So don't go into this if you don't think you can stay with it. the launch phase and the order phase. Do you like that picture? Anyway, I'm Jim Barlow, OakTree Premium Finance. There's my office phone number. There's my mobile phone number. There's my email address. There's my website, and the QR code. If you want to take a picture of that, just leads you to a site talking about Kaizen. It's also on my website too. But I've enjoyed presenting this presentation today. I hope you have. And that's it. Let's see. Let me just look. I didn't ask for questions. It doesn't look like I have questions today. But I appreciate those who have attended. And until next month, this is Jim Barlow, OakTree Premium Finance. Bye.